In 2025, the U.S. government quietly erased 818,000 jobs from its official statistics. That was the largest shock since the Great Recession. Yet Wall Street celebrates record profit margins and surging stock prices. If the economy looks unbreakable as millions vanish from the workforce, what is really driving this jobless boom? Behind the headlines, AI is rewriting the future of work at a pace few dare to acknowledge, and the consequences are just beginning to surface. So how much of what you think you know is already out of date? In August 2025, the Bureau of Labor Statistics stunned the country by quietly revising its job growth numbers downward, erasing 818,000 positions from the books. This was not a minor adjustment. It was the largest correction since the aftermath of the 2009 financial crisis. The jobs were not lost in a sudden crash or mass layoff. They simply never existed. For months, official reports had counted positions that turned out to be ghosts, phantom jobs created by a statistical model that failed to track the real churn in the labor market. The culprit was the so-called birth-death model, a formula the Bureau of Labor Statistics, or the BLS, uses to estimate how many new businesses are starting up and how many are shutting down. In normal times, it smooths out the noise. But in 2025, as AI swept through entire industries, the model broke down. It projected optimistic hiring by small firms, just as many of those firms were quietly automating, freezing recruitment, or closing their doors. The model's blind spot let tens of thousands of vanished jobs linger in the data, masking the true scale of disruption. Federal Reserve economists and labor analysts began raising alarms in the spring. They noticed that payroll surveys and tax records were not lining up. By the time the BLS Commissioner Erica Grosjean addressed the issue in a late summer briefing, the gap was undeniable. The correction wiped out nearly a year's worth of supposed job growth. It cast doubt on every headline about a strong recovery, raising uncomfortable questions about how much of the economy's strength was simply a mirage. The correction did not just rattle economists, it shook trust in the numbers that shape policy, investments, and even the sense of security for millions of workers. If nearly 1 million jobs can vanish from the record without anyone noticing, what else is being missed? As official statistics falter, the disconnect between Wall Street's confidence and Main Street's anxiety grows harder to ignore. The numbers may look solid on paper, but beneath the surface, the ground is shifting fast. Corporate America is raking in profits at levels not seen in decades. The S&P 500 has surged 28% since the spring of 2024, pushing stock portfolios to new highs and rewarding investors who bet on the biggest names in tech and finance. Profit margins for major U.S. companies now hover around 12 to 13%, a record in modern history. On paper, this is a golden age for business. But behind the glowing earnings reports, something fundamental has changed. Companies are making more money with fewer people. As layoffs ripple across the workforce, boardrooms are celebrating efficiency. Amazon, Microsoft, and Salesforce are posting double-digit profit growth while announcing thousands of job cuts. These are not isolated cost-saving measures. They are part of a calculated shift, replacing human labor with artificial intelligence wherever possible. For many chief executives, the math is simple. AI systems do not ask for raises, take sick days, or form unions. Each percentage point shaved from payroll flows straight to the bottom line. The incentives have never been clearer. In 2025, Amazon's profits soared even as its corporate workforce shrank. At Microsoft, net income jumped 18% the same year it eliminated 15,000 jobs. Salesforce cut 4,000 customer service positions, then watched its operating margins climb. Across the S&P 500, the story repeats. Less headcount, more profit. Chen Zhao at Alpine Macro put it bluntly, this is something completely different from the historical playbook. Wall Street rewards these moves. Investors pour money into companies that promise to do more with less. The result is a widening gap between financial success and job creation. For every headline about record quarterly earnings, there are thousands of workers quietly pushed aside by automation. The stock market celebrates, but the workforce grows smaller and more anxious. The paradox is now impossible to ignore. As profits soar, people vanish from payrolls. The race to automate is not just about survival, it is about maximizing returns in a market that prizes efficiency above all else. The pressure is on every executive to keep up, fueling a cycle where the next round of layoffs is not a sign of weakness, but a badge of competitive strength. Mark Benioff did not bother to hide the new reality. In March 2025, the Salesforce chief executive officer did not mince words. He said, "I need less heads," explaining why the company had just cut 4,000 customer service jobs. For years, Salesforce had been the poster child for Silicon Valley's growth story, hiring thousands to field customer questions, resolve billing issues, and support clients around the clock. Now the same company was rolling out AI agents to handle more than 1 million customer conversations every month. The message from the top was blunt. AI was no longer a side project or a distant threat. It was the new backbone of the business. Inside Salesforce, the changes landed with cold efficiency. Hundreds of support workers spent the first months of 2025 training the very AI systems that would soon replace them. They labeled data, reviewed transcripts, and flagged common problems, feeding the machine learning models that would become Agentforce, the company's flagship AI support agent. Then in March, the layoffs hit. Thousands received notification by email, their roles made redundant almost overnight. The company's restructuring budget ballooned to nearly $300 million for the quarter, covering severance and transition costs. No retraining programs were offered. The message was clear. Automation had arrived and there was no path back. Benioff was unapologetic about the strategy. On a private call with executives, later leaked to the press, he described the AI rollout as a competitive necessity. He said, "Wall Street wants to see margin growth. We can't get there with the old headcount." The results were immediate. With 4,000 fewer employees on the payroll, Salesforce's operating margins climbed to record highs. Investors cheered, the company's stock price surged, and analysts praised the disciplined focus on efficiency. The human cost was easy to overlook from the boardroom. For the workers who had spent years building relationships with customers, there was no severance package big enough to soften the blow. Some turned to gig work using the same AI tools that had cost them their jobs to scrape together freelance income. Others found themselves locked out of the job market entirely as more companies adopted similar AI systems. The traditional promise, work hard, move up, earn security, no longer held. Now even the most basic support roles had become a line item to be optimized away. The human impact was immediate and lasting. Salesforce's decision set a precedent that rippled across the industry. Other chief executives watched Benioff's blunt admission and saw a new playbook: cut staff, automate, watch profits rise. The old social contract between employer and employee, already fraying, was now openly rewritten in the language of efficiency. The calculus was simple: every job eliminated by AI was another boost to the bottom line. And as Benioff's confession made clear, there was no going back. Satya Nadella did not wait for the future of work to arrive. He built it inside Microsoft. In January 2025, he told investors that nearly a third of the company's code was now written by AI. That is not a hypothetical. On any given day, AI systems like GitHub Copilot crank out lines of code, troubleshoot bugs, and handle routine updates once assigned to entry-level developers. The result was that Microsoft cut over 15,000 jobs in 2025 alone, the majority from programming and engineering. Net income soared by 18%, even as the workforce shrank. Inside the company, the effects are visible in every product cycle. Teams that once relied on junior coders now launch updates with a skeleton crew, leaning on AI to fill the gaps. Nadella has been direct. He said on a spring earnings call that AI is not just a tool, it is a co-worker. It is a coworker that never sleeps, never calls in sick, and never asks for a promotion. For Microsoft, the economics are irresistible. For recent graduates and entry-level workers, the door has all but closed. The pattern is not limited to tech. In banking, the calculus is shifting in quiet but profound ways. At JP Chase, managers received new guidance as AI rolled out across back-office operations. The message was clear: hold off on hiring unless absolutely necessary. Routine tasks, processing paperwork, Handling internal queries, reviewing contracts are being handed over to AI systems. Analysts project that operations and support staff at major banks could shrink by as much as 10% over the next 5 years, not through mass layoffs, but through attrition and a steady freeze on new hiring. JP Morgan's CEO, Jamie Dimon, has spoken openly about AI's role in boosting efficiency, investing billions to automate the plumbing of finance. In practice, that means fewer entry-level jobs, fewer promotions, and a workforce that grows leaner even as business volume increases. The logic is simple. If I can generate code, analyze contracts, or respond to customer requests in seconds, why keep teams of junior staff on payroll? Across the industry, this question is shaping every hiring decision. Goldman Sachs, Bank of America, and other giants are following suit, using AI to handle everything from fraud detection to compliance checks. As a result, the traditional career ladder, start at the bottom, learn the ropes, work your way up, is quietly disappearing. The shift is not just about headcount, it is about the nature of work itself. At Microsoft, AI-written code is not just faster, it is changing what human engineers do. Senior staff now spend more time reviewing AI output and less time mentoring juniors. The apprenticeship model, once the backbone of tech and finance, is starting to break down. The consequences may not be visible in quarterly earnings, but they are already reshaping the workforce behind the scenes. For now, the numbers tell a clear story. 30% of Microsoft's code is written by AI. 15,000 jobs gone in a single year. At JP Morgan, a quiet hiring freeze is underway as AI moves in. The pressure to automate is relentless, and the old promise of steady advancement, do the work, climb the ladder, is being rewritten by algorithms. Klarna's chief executive officer, Sebastian Siemiatkowski, once boasted that his company's new AI assistant handled 2.3 million customer conversations in a single month, work that used to require 700 full-time agents. In public, he celebrated the cost savings. Behind the scenes, Klarna slashed its workforce from 5,500 to just over 3,000, a 40% reduction. The AI rollout was fast and sweeping. Customer support teams were told their jobs were being automated, with no offers of retraining or transition. For workers like Maya, who had spent 3 years answering customer queries, the news arrived by email. Her role was gone, replaced by a chatbot trained on the very script she had helped refine. In the first months, profits soared and investors cheered. Klarna's revenue per employee jumped from $400,000 to $700,000. But the reality was not as seamless as the press releases suggested. By spring 2025, complaints about service quality began to mount. Customers reported unresolved issues, robotic responses, and a lack of empathy when problems got complicated. Internal data leaked to Swedish media showed AI error rates were 20 to 30% higher for anything beyond routine questions. By May, Klarna quietly began rehiring humans, often on flexible remote contracts, to handle escalations the AI could not solve. Siemiatkowski admitted the company had over-prioritized cost over quality. Klarna's reversal exposed the limits of full automation. The promise of instant efficiency gave way to a destructive cycle. Cut too deep, quality falls, then scramble to rebuild lost expertise. For Maya and hundreds like her, the return offered little comfort. The jobs were different now, less secure, more fragmented, and always shadowed by the next wave of automation. Ethan graduated with honors last spring, a computer science major from a top university. He sent out over 200 applications. Most never reached a human. At every turn, his resume was filtered by automated systems, flagged for lacking the 3 years of experience now listed on so-called entry-level postings. His friends faced the same wall. Signal Fire's latest data shows a 50% drop in entry-level tech hiring since 2019. Only 7% of new hires at the largest tech firms in 2024 were recent graduates. The rest of the jobs went to candidates with longer track records or to no one at all, the tasks now handled by algorithms. But the problem runs deeper than statistics. 88% of companies now use AI to screen candidates before a human ever looks at a resume. University of Washington researchers found these systems favor white associated names 85% of the time, regardless of qualifications. For Ethan and thousands like him, the first hurdle is not just experience. It is an invisible algorithm that decides their fate in seconds. The pipeline for future leaders is breaking down. Junior roles that once taught problem-solving and company culture have been automated away. Mid-level managers feel the squeeze as fewer new hires come up behind them. In the video game industry alone, 45,000 jobs vanished since 2022, with entry-level developers hit hardest. Dario Amodei, Chief Executive Officer of Anthropic, warns that half of entry-level white-collar jobs could disappear within 5 years. He calls it a risk on the scale of the Great Depression, one most people do not see coming. For now, the watch list grows. Every new graduate, every displaced worker, every industry quietly rewriting its future. Today, nearly 12% of American jobs are automatable, while over half of entry-level hiring has vanished since 2019. As AI quietly redraws the employment map, the ladder millions once climbed is missing its first rungs. The future of work is being decided behind closed servers, not boardrooms. What happens next depends on who is left to shape it. Share your take below. This story is still being written.